All right, this is the fourth video in this series. The first video we did was 200-day moving average, then it was the 50-day moving average, then it was the 20-day exponential moving average, and now we're going to talk about one of my favorite oscillators. It's called the RSI index, okay? It's available on every platform. It's called RSI, Relative Strength Index. The only change is the standard setting is 14 days. I like to modify the change it to 10 days. Because we're using shorter term market swings. We're actively trading. We're swing trading, day trading. We're not position trading where we're holding positions for 2-3 months. So what we want to do is we want to change the 14-day period to a 10-day period so it's a little bit reactive. Now, why is this oscillator important? How do I use it? The oscillator goes from 0 or negative to positive, all right? It actually goes from about 20 to 80. Anything above 80, like right here, is telling us that it's overbought. All right, so when you see the RSI above 80, like right here, it's telling us that markets are going to pull back. Now, it doesn't happen a lot. As you can see here, over the last year, we've barely had any readings where the RSI was above 80. And the reason why I'm showing you the RSI oscillator now is this. And again, anything below 20 or anything above 80 means anything below 20 means it's oversold. So this is oversold right here. And anything above, so we got 20 and 80. And anything above 80 or anything below 20 is what you want to watch out for. If it's in between 80 and 20, it doesn't matter. But if it goes above 80, like right here or like right here, that means price action is overbought. And if it goes below 20, like right here, it's telling us price action is oversold, and it'll probably go back higher. Now, why is this important? First of all, there's a lot of oscillators out there. The RSI is not a sensitive oscillator, which means it's not going to give you a lot of false signals. That's number one. Number two, the RSI works really well with the 20-day moving average, the exponential one, the one that's on this screen right here, this one right here. All right. Why does it work well with the 20-day exponential moving average? Because it'll help you understand when price is oversold or overbought in relationship to the index or the line, not the index, but to the line. So the 20-day moving average, sometimes you want to see if price is above it, is it getting oversold or is it still a good time to buy? Overbought or a good time to buy? Right here, is it overbought or is it a good time to buy? Should you wait for a pullback? Is it going to be oversold when it gets to a pullback? So what you want to do is you want to look at the oscillator at the same time that you're looking at the price action so that you can gauge and get a good feel for market sentiment. Is it at 80? Is it at 20? If it's 80, you may want to wait for a pullback. If it's at 20, it means the price is oversold and it may be a good buying opportunity. So overbought, oversold. That's how you need to remember it. And always look at it in comparison to the 20-day exponential moving average because it'll give you a good feel for short-term price action. I hope that helps.